Jim Simon's philosophy of quantitative trading was never confined to theory. It was executed to its ultimate degree in one real-world battle after another. Among these, the most legendary are the bond market crash, triggered by the 1994 Federal Reserve rate hike and the global financial tsunami caused by Russia's 1998 government bond default. In both crises, Simon's team staged stunning comebacks against the prevailing market tide, proving the power of quantitative trading with concrete results and catapulting the Medallion Fund to fame. In 1994, the Federal Reserve unexpectedly announced an interest rate hike. The move, which came with no warning, triggered an immediate global bond market crash. Countless traditional investors were caught off guard, suffering massive losses, with many institutions pushed to the brink of bankruptcy. Yet Simon's team, leveraging their meticulously refined quantitative models, had detected anomalous volatility patterns in the market a full 72 hours before the hike. By analyzing historical interest rate adjustment data and bond market fluctuation patterns, their models generated clear trading signals. On the trading day, the team hesitated not at all. There was no extra discussion, no agonizing over why the Fed hiked rates or how long the market would fall. They simply executed the orders dictated by the models with strict discipline. The entire process was quiet and orderly, standing in stark contrast to the chaos engulfing other Wall Street firms. At the close, the Medallion Fund had booked a single-day profit exceeding tens of millions of dollars, achieving a miraculous profit against the prevailing disaster in the global bond markets. A young researcher who had recently joined the team, unable to contain his excitement, sought out Simons and pressed him. "How did we do that? When everyone was panicking, why could we pinpoint the profit opportunity so precisely?" Simons, wiping a whiteboard dense with mathematical formulas, smiled and replied, "The market never lies. It just speaks in the language of mathematics, and we've just learned its grammar." This statement not only captured the core logic of quantitative trading, but also became one of Simon's most iconic quotes, remembered by countless traders. In August 1998, Russia's government bond default triggered a tsunami across global financial markets. The crisis proved far more destructive than anticipated. Long-term capital management, LTCM, the dream team steered by two Nobel laureates and once revered as legendary, saw $4.6 billion evaporate in just 4 months, teetering on the edge of collapse. Wall Street was a scene of devastation. Countless institutions slashed their positions or even halted trading altogether, as panic gripped the entire financial system. Meanwhile, in a nondescript office building on Long Island, New York, Simons held a coffee cup, his eyes lightly scanning the flickering numbers on the screen, a faint smile playing on his lips. His team, leveraging their continuously iterated and optimized quantitative models, had precisely identified arbitrage opportunities within the chaos and positioned themselves against the tide. "Another 37%, he said softly to the team beside him, his tone calm and utterly unruffled. That year, the Medallion Fund delivered a staggering 66% net return against the storm, emerging as the uniquely triumphant winner of the financial maelstrom and cementing Simon's Wall Street reputation as the wizard of mathematics.